Hey traders, Raghee here. Welcome to Charts and Coffee. Hope everyone is having a good Monday morning. Hope you got some fun and non-trading things done over the weekend. Stepping away from the screen, stepping away from the charts for a bit, especially after last week. It's really easy to get sucked up into the doom and gloom and the growth scare and oh my gosh, the carry trade unwind 2.0 and whatever else it is that financial media is going to use to grab your attention. So you watch the ads. So let's take a more measured approach to what it is that we're focused on this week. And, I touched on this yesterday in Top Tier Outlook, and I think it's a really important point. Ultimately, you and I, as we're taking a look at the markets, for the most part, if you haven't thought about what your typical trading style is and the time horizon associated with it, this would be a great time to do that. You might say, Rob, what the heck does that mean? Are you a day trader? Are you a short-term swing trader? Are you a longer-term swing trader, or are you an investor? It's easy to put yourself into primarily one of those four categories. And you're probably like myself doing a little bit of both. So you have to know which hat you're wearing when you're looking at the chart. And that's the first way to sort of defend yourself against the constant barrage of the world is ending narrative that obviously dominates television. The other part of it is, and I think this one's a little bit trickier, but that is be careful who you listen to. And I'm saying this to someone who's probably tuned into Charts and Coffee for a while. You might say, Rob, why am I going to listen to you? I'm a trader. That's the way I'm going to talk about what's happening right now. And I hope that I'm being specific to the time horizon. So if you have any questions about that, feel free to ask. But in a day and age where, if you take a look at what's going on in the traderverse, everyone wants the day trade. Everyone wants 0 days to options expiration, which means what? They're by and large day traders. And yet growth scare and carry trade unwind and all this other longer term macro, that has nothing to do with what I'm going to do between 9:30 and 10:30 this morning with the ambition of having a couple good day trades that will be closed 10 minutes from the bell. To be careful what you're letting in, be careful what you're letting influence you. Now, if you're looking at a longer term swing trade, that's going to matter some, right? If you're going to be in the market overnight, 2 to 10, maybe longer, let's call it 2 to 10 to maybe 21 days, right? That's a pretty common overnight longer term swing time horizon for me. Yeah, some of that back and forth day to day. What's the fear mongering headline today that's going to be guiding sentiment? Those things kind of matter. But if you want to take another step back and say, all right, let's step way out to say a weekly time frame and the trends that we have there. Well, if you pull up the S&P futures on a weekly time frame, and if you're using some of the tools that I use, like the top tier wave, you'll see that we made a mean reversion with that Monday sell-off. So what was a crash in Japan was not a crash in the US. It was simply a mean reversion of a trend that's dominated the weekly time frame all year long, right? Now, let's also tackle another bit of techno babble that we're going to hear a nauseating amount of, and that's growth scare. So again, just because someone shows up on television doesn't mean they have a clue as to what they're talking about. I've been hearing folks, and I'm not going to name names, but there's one person who's a college professor, tenured no doubt, and an economist. This guy is saying we need a 3/4 point cut. All I want to know is what are your holdings and do you manage money? Right? Another one's a TV commentator, I think, calling for an emergency Fed meeting. Again, all I want to know is do you trade or invest and do you manage money? Right? So be careful who you're listening to because they'll give the mic to anybody. And frankly, that became abundantly clear last week. So we have to stand guard at the gate of our mind, know what our time horizon, know what our trading goal is, and stick with that. So that being said, after that extreme move in the dollar yen, in the VIX. A lot of folks are saying, okay, Rag, I get it, but could you explain to me what on earth happened? This is not unlike what happened in '08. Let me explain. Now, this is not an '08 scenario. The way that it unwound had a lot to do with '08. All right. And the reason is when someone puts on a large position, these institutions, these asset managers, insurance companies, you name it, they have a tolerance of how much that particular position can move against them. Not really a stop loss, but more like a standard deviation move that the model can handle, right? That's what happened in '08 when we went way beyond what those models were built to handle. And those models were hilariously enough built primarily on the thought that real estate prices could never go down quickly. Wrong. But again, the model is the reality. So if their model is that a standard deviation in the yen against the dollar is about 1.3, so just over one standard deviation. So it made sense that their risk tolerance was built on a one standard deviation move. I believe we had a 5 standard deviation move when the US dollar weakened and the yen strengthened. And in fairness to them, those models then broke. And then those trades became negative, and then they had to sell other things to make, on and on. We know what happened after that. But that's why it happened. We moved beyond the typical standard deviation. Now, then the question becomes, well, are we still in that environment? Are we still seeing yen strength and dollar weakness? No, we are in fact not. Let's take another step back. Typically when we see, and I like to use the VX futures, typically when we see a spike in VX, and we've seen spikes like this a handful of times, and they're usually in extreme panic situations, right? '08, pandemic, and last Monday. Those spikes, if you're willing to step back, right, and not tune into the panic on television, again, their goal is to get you to watch ads, right? You'll realize that, okay, let me go look back on the last 2, 3, 4 times that we had a VIX spike. It's easy enough to do. Pull it up on a weekly chart, pull it up in a daily chart, look at the last 10 years, look at the last 15, you'll see by and large on that spike in the VIX and the sell-off in the S&P. Now let's talk about VIX and S&P because VIX is based on SPX options, right? 6 to 12 months forward, we're usually at higher highs. Okay, that's a pattern, that's a tendency, at least I can start to build positions on, right? And that's where we are right now, a week after, the week after supposedly the world was going to end. All right. And we're here anyways. And hopefully everyone had a good weekend and got to decompress from the craziness from last week. All right. So, look, it's really easy to sit here and go, crash is coming and these are the big pullbacks. And frankly, I'll be straight up. It gets clicks, right? It's our fault because we click on that nonsense. So they keep churning that out. If we start paying attention to folks who are saying, okay, this thing happened and it was kind of scary, but here's the opportunity, no one wants to hear that. We love the fear mongering. We love the train wreck, right? We love the dumpster fire. So, again, remember what they're optimizing for. TSM. All right, question here on Taiwan Semi. I'll tell you, I really am going to steer clear of semiconductors. They're one of the worst performing sectors still. If you're looking at longer term, even the weekly is a little tricky. I'd be careful with the weekly until it reverts to the mean around. Gosh, we're nowhere near that right now. So I'm going to steer clear of semiconductors because, again, my time horizon is not necessarily with semiconductors 6 to 12 months from now. It's going to be more, what can I do to buy financials? Are there mean reversions on the indices? So I'm leaving tech alone, and that's going to include TSM. Doesn't mean a week or a month from now, it may not be different, but right now, it really is quite a mess. All right, as far as Pepsi goes, okay, so now we're talking about a sector that's in an outperforming group, the top 5, and Pepsi's a stock within it. And there are a number of stocks in the XLP that are performing well. Pepsi would be one of them. Coke would be another. There are a handful. So I would keep an eye on Pepsi. Sure. Yeah, I would absolutely keep an eye on Pepsi for a long position as long as staples continue to outperform. And the closer you can get to the reversion to the anchored VWAP, probably the better. I do like that as a potential level of entry. This is the anchored VWAP anchored to the first trading day of the year, which in 2024 was January 2nd. So I do like the long position there. All right. What about the Dow and financials? Yeah, great pairing there, Patrick, because the number one weighted sector in financials is, or in the Dow, are financials. Dow is still struggling. Look, we're not out of the woods yet, but we're just not continuing to see the panic, right? Before we move higher, before there's any kind of optimism, we're going to get core retail sales this week. We're going to have PPI data this week. We're going to have CPI data this week. We're going to get the preliminary University of Michigan inflation expectations this week. And then next week, we're going to hear from Powell and company in that sort of informal FOMC meeting, which is the Jackson Hole Symposium. And in that symposium, Powell, who has certainly been seasoned by some very poor decisions back in 2018, where he defied expectations around what traders and investors were expecting with rates. If you recall, he hiked in 2018, where it was largely expected he would pause. He ain't going to do it again, right? He realizes he's got to give the market that quarter point cut. No more hedging, no more hemming, no more hawing, no more rogue, hawkish, idiot Fed members out there, right? He's got to get the consensus together. Remember, the Fed chair's job is a hard one. Get all these other humans with all their opinions and agendas out there, and he's got to make sure that come the Fed meeting on September 18th, he can garner a consensus where everyone's going to basically fall in line and say, all right, we agreed to do this. I might have some disagreement, but we're all in agreement. It was a unanimous vote. So his job is to get that consensus. It's not an easy job, gang. I mean, we're talking about humans, and in this case, humans that are economists, and they think they know where the markets are going, and they're going to have their own opinions. But at the end of the day, come the 18th, I do have faith in Powell to get that consensus. He's done a good job shutting the hawkish Fed members up. You remember what April was, right? Yeah, I'm talking about you, Bowman, right? So we had certain members that were talking about rate hikes, which sound ludicrous now. Fast forward to August. What a different world April to August is. So once he gets that consensus, the anticipation of rate cuts is more bullish to the indices than the rate cuts themselves. Cuts are not bearish, they're just not as bullish as the anticipation. So with something like the Dow or even financials, Patrick, I would step way back to a weekly and look at, if you're comfortable, if that is something you would do, I'd look at the longer term time horizon. Where could we be 6 to 12 months from now, not 6 to 12 days from now, or even 6 to 12 weeks? Although I am still largely bullish, but bullish is not the same thing as buying, right? I could say, hey, I'm bullish, but buy nothing. It's just, what direction would I prefer to be in an overnight longer term position? And right now, I'll reiterate what I mentioned in top tier show yesterday. Short-term day trading, longer-term weekly, and a very case-by-case basis, mostly focused on staples for swing trades, right? And even a little bit of gold miners. We're in a long position in NEM. We're in long positions in utilities, staples, Coke, and that's pretty much where I've been. I probably could have been a little bit more active last week, but I thought, I'd rather be in positions where I wish I got in versus I wish I didn't. What are you optimizing for? For me, it's always a matter of, Rog, are you going to wish you took it, or are you going to wish you didn't? And I'm always going to optimize for the latter. Flat is a position, right? Okay, next up, do I monitor the MOVE index, Dave? No, I do not. No, I know a lot of folks like to. Again, I think it turns into a very slippery slope of people's whose job it is to talk about the market versus people and give advice about the market and be an analyst or newsletter writer. Hey, I write a newsletter. But when I'm not spending about an hour or two writing that newsletter, I'm in a live environment trading, right? I'm on the tightrope with everybody else. There's a lot of folks that isn't their job. Their job is to break down the minutia of the market and give a hypothesis. But I'll tell you, the longer I trade, the longer I do this adulting thing, I really don't care about anyone who's not a practitioner. Either you're in the trenches with me, you know what it feels like to have an open position, or you don't. Hence, I don't care what a commentator says. I don't care what an analyst says. I don't, those kinds of things. And I have found there's a lot of folks who talk about certain market dynamics, and at the end of it, you go, well, do I buy this or not? And that's where, for me, at the end of my analysis, even what I'm doing here, Rog, what would I do? Nothing, long, short. That needs to be the punchline. That needs to be the final, final part of the conversation. Is there something to do? With NVIDIA, I would not focus on the long side of the daily chart. Again, semiconductors, NVIDIA, Taiwan Semi. I'm right now, I'll tell you again, I could not care less about tech. And I mean that respectfully, but I mean that sincerely. There's so many other places that are outperforming. If you're looking at tech right now, look with a 6 to 12 month time horizon, not what's going to happen today or tomorrow, unless you want to short, in which case those are probably pretty good candidates for near term, short term swing plays to the downside, long puts. T I like a lot. Now, T is funny. T Telephone, AT&T, this is a strange little overlap that exists in modern ETFs, which is there's this XLC Communications ETF, and it's a relatively new ETF compared to a lot of the others that are heavily weighted in the indices. And it overlaps with the telecommunications sector. So communications overlaps with telecommunications. And what's making communications look stronger than they probably really are is the telecommunications part of it. And T is probably one of the best looks. So Nacho Wu, I need a pullback, but yes, I definitely want to look at long positions in T again. We've done it before back in June, July, and it's not the same trend we had back then, but it's most definitely still a relative outperformer. All right. So next up is sometimes the hard. Yep, that's so true. Sometimes the hardest part is not participating. It's being able to have the discipline to say, I don't have to do anything, right? And for me, remember, we're in a job where we're not in a time-based economy. I don't walk into my office here, punch the clock. Nothing wrong with that, but that's not how I get paid. I don't get paid for sitting here. I don't get paid for spending time in front of the screens. You and I, we're entrepreneurs. We live in a results-based economy. The market, the screens, the charts, the price, they don't give a rip that I've been here since about 6:30 this morning. They just don't, right? They only care is, did you buy, did you sell, and did you make some money doing it? And so we live in a results-based economy. And in that mindset, sometimes doing nothing is better than doing something, because a bad something could actually cost us money. I could sit here for a week and make a lot of bad decisions, but stay busy and actually lose money during the week, right? And I'd rather be flat. That's why I optimize for, I'd rather not lose money than take a trade that is risky or makes no sense from a risk reward standpoint. All right, can we go over the FANG? I'm guessing you mean Diamondback Energy, Joe. Not as weak as it once was. The only stock in energy right now that I'm looking at is Exxon. Yeah, that's the only one right now. So in terms of, yeah, Diamondback Energy or Occidental or ConocoPhillips and so forth, yeah, the only one that's really got my attention right now is Exxon, which is a tricky place to be because Exxon's basically swimming against the current, and a swift one at that. And as long as crude oil's struggling, and crude oil's reflecting what? It's reflecting some economic slowdown. Remember, gang, again, I kind of alluded to the ludicrousness of the growth scare. The US economy for a decade has been averaging 2 to 3% per year, right? We're still mostly in that window. So the idea of a growth scare would have to be below 2%, right? And so, again, they have to talk about something, right? And so right now there's some expectation that there's going to be economic slowdown, which is, again, I'm not saying it's right or wrong, but crude oil is likely reflecting some of that. But you'll take a look, it's been rallying again back to the 200. So I'll be very interested to see as we wrap up August if crude can regain 80. If it can, a lot more energy stocks in oil and gas explorers, oil services, and the energy ETF like XLE should benefit. But again, this is fine to say right now, there's nothing I really want to do with energy. I'd like to be long eventually. Crude oil on the weekly has been holding the anchored VWAP that I keep on a weekly pretty darn well. And so ultimately, when I'm looking at crude right now, I am still marginally bullish with a longer term time horizon. But right now, this is a downtrend. Right now, crude is in a downtrend, and it has been since the 6th. All right. So that is it. Duke is up. But remember, Duke is utility, right? Yeah, Duke is a utility. So I would put that in the XLU utilities camp, right? So don't look at Duke as something in the energy space. Look at that as something in the utilities space. All right. Okay, gang. Be good to each other. I'll see you tomorrow. Same time, same station.